Since last November, when China announced a dramatic U-turn of their zero-COVID policy, equities in emerging markets staged a rather spectacular relief rally. So at the start of this new year, that begs the question, is this recovery likely to continue in emerging markets or not? Well, to answer this question, it's important to first look back at what happened during 2022. There were many headwinds for emerging markets, with next to geopolitical tensions, on the one hand, China's many lockdowns, problems in its real estate market, and also worries after the Chinese Communist Party's Congress, where President Xi Jinping took total control by only allowing loyalists to his Politburo team. On the other hand, in the US, we had a much tougher central bank and also a stronger US dollar. A perfect storm for emerging markets. At the start of 2023 though, many of these headwinds are now turning or are about to turn into tailwinds. In China, the zero-COVID policy is over. There was a relief package for private sector property developers. Most of the crackdown in the technology sector seems to be behind us, and we have witnessed a clear pivot towards prioritizing economic growth. At the same time, the US central bank may adjust its pace of rate increases, meaning that this headwind will not have the same negative impact as before. If only China could also somehow manage to stabilize its tense relationship with the US, then things might look a lot better. All of this, combined with a pessimistic investor sentiment towards anything related to China and emerging markets, has driven valuations lower. Recently, emerging markets have been trading at a 35% discount to developed markets on a price-earnings basis and a 45% discount on a price-book basis, amongst the widest discounts in nearly 2 decades. That leads us to believe that emerging markets may be one of the most under-owned and mispriced asset classes. With that in mind, the spectacular year-end rally and also the good start in the new year shouldn't be all that surprising. So, with a diverse opportunity set, plenty of fundamental drivers, and now headwinds turning into tailwinds, it isn't too hard to see why, through active management, emerging markets look to be set for a better year ahead.